All right, now when company, this is part three of the assets, of the balance sheet. Assets was in part one, liabilities part two. We're going to do shareholders equity in part three. Shareholders equity is money that is the residual value that is either supplied by the shareholders themselves or that the firm earns on its own, and rather than give it to the shareholder says, no, let it ride. And that's essentially what the net income that arises each year from the operating activities of the company. They take the net income and they give some of it to shareholders as a dividend, but the shareholders oftentimes they don't want it. I say, you keep the money. If you're making a lot of money with it, why don't we just plow it back into the company so I'll make even more? All right. So there's actually two major categories of equity: contributed capital or contributed equity capital, from the outside. When a firm sells shares of stock to investors, that money goes into common stock and paid in capital. Now, most financial analysts use one word for all of that, common stock and paid in capital, because it's all this basically the same thing. There's some technical reasons for a difference, and you'll see companies reporting a difference in their income statement, or the balance sheet rather. And if we go down here and look at a balance sheet, of course I went the wrong way, go back up or edit this out. If we go up here and we're looking at Flowers Foods, it's a little bit hard to read, but you'll have access to the 10Ks because they're posted on the site. Where you see down here, stockholders' equity, preferred stock, and there's zeros. You get down here, that made those dashes mean we don't have any. Common stock, dollar sign 0.01, that means a penny stated par value and a tenth of a penny current par value. That just means nothing. So when they report common stock, they're reporting $199,000. But what people actually paid is the common stock plus the capital in excess of par value. So what people actually paid gets split into two pieces: common stock and then paid in capital, capital in excess of par value. Goes by different names by different companies, but it's all the same basic concept. Let's see if I probably went the wrong way with Tiffany. Tiffany is calling theirs common stock with a penny par value, $1.2 million, additional paid in capital. That's the $1,387,000,000 of money that they got. So if you add those two numbers together, that's the amount of money that people actually gave to Tiffany's in exchange for shares of stock. The retained earnings. Retained earnings is net income of Tiffany's. That's the money the firm has earned minus any dividends that they paid. So this is the amount that the shareholders let the company keep. So we have contributed capital, which is common stock or common stock and paid in capital, and earned equity or internal equity from the inside. All right, now there's some other activities out there that go into shareholders' equity. Sometimes companies issue shares of stock, and we don't know when this stock was issued. It says here, Tiffany's issued $1,388.5 million worth of stock. It could have been last week. It could have been 40 years ago. These are based on historical values, and that's just telling you what that number was when they issued it. The retained earnings for Tiffany at $2.2 billion. That means since they've been keeping track of Tiffany's, they have earned $2.2 billion more in net income than they have paid out in dividends. Okay. Now, there's something else down here called treasury stock. A company can issue common stock and then buy it back. Now, they might issue it when at $10 back in 1952 and then buy it back at $50 in 1993. Whatever they sold it for, they record as common stock and paid in capital. If they buy back the shares, that's recorded in treasury stock and what they paid for it. However, this is one of those situations where you don't really know which bucket to take it out of. When we bought back those shares of stock, like they did at Flowers Food, did you buy back the shares from the retained earnings, or did you buy back the shares that you had sold here? And the thing is, you can't really separate all this out. So treasury stock is a contra account, which means it's negative where it's usually positive. Okay. And what it does is reduce shareholders' equity and we have this separate number in here just to let everybody know that, yeah, we issued a lot of stock, but we bought it back here as well. And then this other equity category can be a lot of stuff with large companies and or publicly traded companies. This number tends to sometimes be positive and sometimes negative, and it's way more complicated than we're going to get into. The two numbers that you need to really focus on, contributed capital, that's money from the outside. In your textbook, they'll call that common stock, but it's really common stock and paid in capital. And retained earnings. Retained earnings is the equity that the firm has earned and retained rather than give to the shareholders as dividends. And we won't go into treasury stock other than that's simply the company sold stock once upon a time and then bought it back from their shareholders. We can see from these two companies, and remember their revenues were almost identical at $4 billion, but the total liabilities and equity are twice as high at Tiffany as they are at Flowers. And the total assets have to be equal to the total liabilities and equity, otherwise it won't balance. So that's why they call it a balance sheet, because the total assets have to balance with the total liabilities and equity. So we can see also, if we look at the total liabilities for Tiffany, about half of it is liabilities, other people's money. About half of it is shareholders' equity. It is shareholders' money. By the way, the shareholders own the retained earnings just like they own everything else. When we look over here at Flowers, of their $3 billion in assets, almost $2 billion of it comes from other people's money, and only about $1.2 billion of shareholders' money. That's called financial leverage. So they use more other people money financing over here in Flowers than over in Tiffany's.